watching Dukascopy TV. I'm Elaine Stenson and I'm joined in studio now by Dougal Thomson, who's Head of Programmes with the Economist Group. He's here with me now to discuss the recent announcements from the Bank of England. Dougal, you're very welcome.
Hi, Elaine.
So Mark Carney has spoken about this forward guidance approach. What exactly does he mean about this in practice?
Forward guidance is new for the UK, but it's not a new concept. Let's start with what he's actually said. He's told people that interest rates, which are at a historically low level of 0.5%, are going to stay like that, not just for the next month, but for the foreseeable future, specifically until a time when UK unemployment falls to 7%. Now, at the moment, UK unemployment is at 7.8%, and the Bank of England themselves think that it will be 2016 before that 7% threshold is reached. So what he's effectively saying is that interest rates are at 0.5% now, and they're likely to stay that way until 2016.
Why 2016?
Or whenever the unemployment rate falls to 7%, but the Bank of England think it'll be 2016. It certainly looks as if it will be a few years at least. Now, having said that, he's given himself a couple of get-out clauses. There are things he calls knockouts that could potentially remove this pledge off the table. Specifically, that's if inflation gets out of hand. Inflation, the target for the Bank of England is 2%, and if their long-term projections, 18, 24 months into the future, are 0.5% above that 2% figure, then they say that gives us the option to take this offer off the table and we'll revisit where we stand on the inflation rate. And the other on the interest rate, the other thing is if they perceive that their stance on monetary policy poses a risk to financial stability, then they've also got the option to remove this from the table. So there are a couple of get-out clauses from this long term. It's not just as black and white as saying interest rates will be at 0.5% until unemployment falls to 7%.
And was this cautious approach what we were expecting from Mark Carney?
Well, he's got form when it comes to forward guidance. He's new in the job. He recently joined the Bank of England as the first non-British governor. He was previously the governor of the Bank of Canada, and he used this technique there, where he made a promise that that interest rates would stay fixed for a 12-month period. So he's done this forward guidance trick before, and not just him. I mean, forward guidance is used by the US Federal Reserve, linked to their own employment data. They've been doing that since 2008. And the European Central Bank have recently started to talk about forward guidance themselves and try and create more reassurance and clarity and certainty. That's what this is all about. It's try to create certainty for markets, for businesses, and for consumers about where interest rates are now and also where they will be some years down the line.
Okay, and you mentioned inflation there a moment ago. And why was he so focused on inflation and getting that up to his target?
Well, it's vitally important. And one of the problems that the UK has is that inflation has outpaced wage growth for at least a decade. So what that means is, while inflation itself is relatively low, it's 2-point-something%, unfortunately wages are growing much slower than that. Unless that can be rebalanced in the long term, it's really going to put a brake on British economic growth.
Okay, and how do you think Mark Carney is doing so far? Because he is only new as the new Bank of England governor.
Yeah, well, the proof will be in the pudding. I mean, there was a fairly sort of mixed or lukewarm reaction to the announcement on Wednesday. The unveiling of forward guidance. It makes perfect sense in theory, but it's a difficult trick to pull off in practice. And when the US Fed recently tried to give more certainty to the markets about when they would start easing off their buying campaign for buying up assets, it actually provoked more uncertainty and angst and agitation than it did reassurance and certainty. So it remains to be seen whether this Bank of England version of forward guidance will work, because it's not as clear-cut as I might have presented it at the start. When you start to think about what those knockout clauses actually involve, they are fairly subjective at the same time. I mean, is the Bank of England taking a view about financial stability, or whether the long-term inflation picture looks manageable or dodgy? What we can predict with certainty is that the markets are going to start looking at UK unemployment figures in a way that they've never had to before.
Okay, and looking at the UK economy, the outlook isn't looking too bad, as the services and manufacturing industries are showing rapid growth from the latest figures. Is this a good sign?
Yeah, I would agree with you that the outlook isn't too bad. I'm not sure I would say rapid growth. Although, I mean, we're coming from a very grim background. By some measures, the British economy is moving from rescue to recovery. That's the term that George Osborne, the Chancellor, uses to describe where we are. And undoubtedly, there are a few green shoots out there on the horizon. GDP grew by 0.6% in the second quarter of this year. We predict that 2013 GDP growth will be 1.2% and continue at 1.2% all the way through 2017. So the economy is growing, and there are some other encouraging signs. Consumers feel increasingly confident about the future. That's good. Small to medium-sized businesses feel more confident. The Purchasing Managers Index, which is a good index to keep an eye on, is at very positive levels at the moment, which suggests that businesses feel slightly more confident now about in investing. But you've got to weigh that against a few inherent long-term breaks on the British economy, the most serious of which is the credit crunch. I mean, the fact is that banks are not lending to businesses in sufficient quantity, and Mark Carney's policy is really designed with that in mind, is to try and get banks to lend to the real economy, high street banks. And in theory it should work, because if you're a high street banker and you know that you're going to be able to borrow money from the Bank of England at 0.5%, not just this month, but for the foreseeable future, then hopefully that makes you more inclined to lend money to the rest of us if we need money to start a business or to buy a house. But we'll see, it's early days.
We will see. Okay, Dougal, thank you for joining us today.
Thanks, Elaine.
And that's all we have time for now, but do check back later for further interviews and updates from the Dukascopy TV team. Bye for now.